Good morning, everybody. Welcome to today's exclusive session on the Invesco India Income Plus Arbitrage Active Fund of Fund. We're thrilled to be joined by Mr. Vikas Garg, Head of Fixed Income Investments at Invesco India. With over 19 years of experience in credit research and portfolio management, Vikas has led some of the industry's most successful debt strategies. Today, he'll be walking us through this new hybrid fund that combines the best of active debt and arbitrage, perfect for conservative investors seeking smart, risk adjusted returns. Over to you, Vikas.
Thanks, Neha, for that wonderful introduction and a warm welcome to all your viewers also on the various channels. Well, yes, indeed, it is a very interesting opportunity through this the new hybrid fund of fund category which has emerged over last few months. Maybe I'll kind of give some opening remarks and then happy to take your questions. Debt investments have always played a very critical role to everyone in terms of making a prudent portfolio allocation over the past many decades. While some other asset classes like equity, commodities, real estate will possibly enhance the overall return. But a debt investment is always necessary to kind of realign the risk of the portfolio as per the risk appetite of an individual investor. And that's where we did see significant emergence of very simple, plain vanilla products, which used to be called like a target maturity fund on the debt side, where the investors were able to use that vehicle for a prudent asset allocation to the debt category. That also used to be much more tax efficient as compared to many other alternative fixed income products like fixed deposits or otherwise. And it used to provide taxation benefit if invested for more than 3 years. However, for last 2 years, there was those changes in the taxation side, and the tax benefits which were available to the investors in the debt mutual funds were withdrawn. And that's where I think in last 2 years, because of higher tax incidence, I would believe that a lot of investors would have got under allocated to the debt investments, which, as I said, otherwise plays a very important role in a way. Unfortunately, last 2 years have also been one of the best years for fixed income market, where we have seen a sharp market rally on the yield side, which has given almost like double-digit returns to the investors on fixed income products. But yeah, possibly that got missed out by the investors as they were not able to invest due to the higher tax incidence. The good news now is that over last few months, a new hybrid fund category has emerged with the clarifications that we as an industry received in the recent budget. And now it's possible to provide true debt exposure to the investors in a more tax efficient way. And that's where I feel so excited about this new category because now it provides that tax efficient vehicle to the investors to be able to come back to their prudent asset allocation, which should comprise debt along with the other asset classes. So yeah, really excited and looking forward to a very good traction. This industry is still evolving. It's a new industry, not more than 3-4 months old. But the initial allocation has been quite promising already. So I think as an industry, the size would have crossed 10,000 crores of AUM in last few months, which really talks about the traction which this category, the new category, has been getting with the investors. And I'm pretty confident that 6 months down the line, we may be multi times of the size that we have as of now. Over to you, Neha.
Okay, that's amazing. Thank you so much for laying down such a good foundation and base, right? So, I have a few questions. If you could answer it, it would be great. So, what is the core investment objective of the fund, right? How does it fit into an investor's long term asset allocation?
Yeah, sure. So as I said, this provides a true debt exposure to the investors in a more tax efficient way. Why tax efficient? If someone was to invest into this category and hold it for 2 years and more, the tax rate would be at a fixed rate of 12.5%, which earlier, used to be at a tax slab rate for the individual investor, which was the case for the debt category in a way. So this ways, I think it does provide a more tax efficient structure. And if you were to look at the other asset class like equity, I think it has become very similar to the equity as an asset class from a taxation perspective. On the equity side, if one was to stay invested for more than 1 year, the taxation is about 12.5%. Over here, one has to stay invested for more than 12 years, 2 years, and then the taxation is the similar 12.5%. So I think someone who is looking at a core allocation, then 1 year or 2 year is actually not that long a time period. It would mean that for the core investors, there is no difference left from taxation perspective, and then hence it can be used for achieving that core allocation for someone in a way going forward.
Right. Okay, so why focus exclusively on income plus arbitrage, right? What makes them an attractive segment in today's economic and market context?
Well, that's the very nature of this hybrid fund category. For one to be able to take the benefit of lower tax rate for more than 2 year investment horizon, minimum investment of 35% has to be made into the arbitrage fund, which also can go up to 65%. But yeah, it has to be between 35 to 65% at any point in time. And the balance can be onto the income opportunities, which are the debt funds. There are various debt funds with a very highly regulated policy boundaries in terms of the risk which can be taken in those underlying funds. So this fund does provide that flexibility to kind of allocate into those various debt funds depending upon the market dynamics. So this structure, which is comprising of minimum 35% of arbitrage fund plus 65% of the debt fund, provides that vehicle which is more tax efficient. And I think why I've been saying that it provides a true debt exposure. So the arbitrage fund, which is 35%, is also more aligned towards the debt segment than the equity segment. It does have equity position, but that's completely hedged. So there is no directional equity exposure which is taken in the arbitrage fund. So while the name is arbitrage fund, but the returns would be more aligned towards the debt category. And similarly, the debt fund is the pure debt category in a way. So through this wonderful vehicle, one possibly is able to get 100% true exposure to the debt segment.
Right. Okay. But how has this particular category evolved in, recent years to justify renewed interest from equity investors?
Well, great. Yes. So this is a new category. This fund of fund structure would have come into existence for last few months only. But there has been a rush of mutual fund houses to launch their this income plus arbitrage fund, and I guess more than 15 fund houses have launched their fund in last 3 months or so, which clearly indicates the high visibility that this category has been getting across the investors. Since it's a new category, the AUM is still evolving. But yeah, it has already crossed more than 10,000 crores of AUM at the industry level. And as I said, I feel extremely confident that it will become multifold from here. This category, I think, is touching the right chords for the investors, especially when, if you were to look at the current market dynamics, uh, it has become extremely volatile. We have been through a lot of global uncertainty led by the US trade policies, and then we have seen a couple of the geopolitical risk also arising from nowhere, which has kind of resulted in a lot of uncertainties, including Indian financial markets. And in such times, the conservative investors possibly would want to kind of realign their risk profile by getting into lesser volatile products. So I think the timing is just perfect, where from that product perspective, this particular fund of fund can be used by the investors to lower their risk profile, and be able to kind of align the portfolio as per the risk appetite of the individual investor. And that's where I think it's getting the traction. Maybe one more thing, so as I say that this in a way provides a true debt exposure to the investor. So from purely from a market perspective, this point in time, even the debt investments are looking pretty promising going forward. So while we have seen a good run over last a year and a half on the debt market, but to us it looks like there is good opportunities are still there on the market side, and uh, currently the yields are elevated. While RBI has cut the policy rates by 100 basis point cumulative and 50 basis point in the recent time of June policy. But all of that rate cuts have not yet been passed on to the debt market, which means that still the yields are elevated, and going forward, we believe that the yields will come down from here. And just to put in a very simple way, when the yields come down, it produces capital gain opportunities for the debt investors, which means the overall returns could be higher than what, let's say, the gross yield of the debt funds that we see as of now. So even from the timing perspective, I think one, it helps us in lowering the risk profile of someone's portfolio, but also it's a good time to kind of make a fresh entry onto the debt side, keeping the view that the market yields will come down from here, which will enhance the overall return for the investors.
Okay. Okay, amazing. So, what is your approach to manage this fund, right? What metrics or qualitative factors do you look at, or what are some of the factors that you focus on?
Yeah, sure. So this is an active fund, and that's how the name itself, which is Invesco India Arbitrage Plus Income Active Fund of Fund, which means that I, as a fund manager, would be very actively managing it. Now, there are two parts to manage it actively. One is in allocation across the debt fund and the arbitrage fund. As per the flexibility, we can go 35 to 65% in arbitrage fund, and the balance would be in the debt fund. So that would mean that we will take a view whether arbitrage fund is looking more attractive, or the debt funds are looking more attractive at any point in time. As we speak today, we do believe that the debt funds may enjoy the benefit of higher carry, which means the higher gross yield as compared to the arbitrage fund. And also, it will hopefully enjoy the benefit of a higher duration as we expect the market yields to come down. So, with this market view, we believe that we should maximize the debt exposure. So which would mean that to start as of now, we would have 35% exposure into the arbitrage fund, and 65% exposure into the debt fund. Now, so that's the first level of, I would say, the active allocation. The second level of active allocation is then to identify the best opportunity across the debt fund. So now over there, I think what is very critical to understand is that we would believe that anyone coming into this fund of fund would have a minimum investment horizon of 2 years, so as to be able to avail the tax benefit thereby. So if someone is looking for that 2 year investment horizon, it makes it more like a core allocation. And if we were to suggest someone from a debt perspective, what should be the fund for that 2 year investment horizon? So the core fund would be like a short-term bond fund or a corporate bond fund, which provides a similar maturity profile as compared to the investment profile of the investor. So that way, the core book for us would be a corporate bond fund. which I believe that minimum 40-45% would always be the corporate bond fund. Out of that 65% that we can invest into the debt side. And then beyond that, we would use the other funds very actively so as to enhance the overall return. Sometimes it could be the gilt fund so as to take more benefit of the duration rally. And sometimes it may be the funds like ultra short money market where we may want to kind of reduce the risk profile of the debt category. If we were to construct the fund maybe a year back, I would have believed that 50% of the allocation would have gone into the corporate bond fund, and 15% allocation would have gone into the gilt fund so as to provide the GSEC exposure. As we speak today, I believe we have seen a good rally on the gilt side, while there is still some rally left as per our conviction. But still, I would believe that a corporate bond fund may provide a better opportunity at this point in time. So today, when we start, it would be entire 65% allocation into the corporate bond fund. And then with time, we would try to kind of find such opportunities again with the time, where let's say coming in Feb and March, where we believe that money market funds may look more attractive for a few months. So the fund would be easily able to kind of shift some bit of allocation from corporate bond fund to money market fund and take the benefit of that rally that we expect to happen in money market fund, and then come back into the core allocation, which is the corporate bond fund. So I think it is going to be very actively managed, both in terms of the allocation to the arbitrage fund versus the debt fund, and within the debt fund also across the various debt categories.
Okay. Okay, so could you shed some light on primary risk factors associated with this particular fund, right? How can investors possibly mitigate these?
Yeah. I think one thing to understand very clearly is that while this fund of fund structure is a new fund in a way, but the underlying funds have been there into existence for decades. So the underlying fund, one is the arbitrage fund, which has been in the market for a very long time. So the risk factors over there are quite well known. Similarly, on the debt funds, all these funds have been highly regulated, as I said, in terms of the risk boundaries, and they also have been managed for last many years in a way altogether. So I would say that the risk associated with this new category would be the risk similar to ones which we have for the arbitrage fund and for the debt fund. And thankfully, I think they are kind of a known risk, and people have been able to kind of have a well-defined reaction function to those risks. So, for example, on the debt side, there could be largely two kind of risk. One is the credit risk, and then one is a duration risk. So, and there are ways to mitigate both of them. So, the credit risk, I would say, becomes much more critical for this set of fund of fund structure, because someone would be looking for a 2 year plus investment horizon. So that's a long investment horizon. So the underlying asset quality has to be pretty robust. So I think for those conservative investors, it makes sense to go for high quality underlying debt fund, which can make sure that there is no excessive credit risk taken, which possibly could provide some sensitivity over that longer period of investment horizon. Similarly, on the duration side, I think that's a very dynamically managed part of debt fund. But overall put, as I said, the core allocation, at least from our side, would be largely into the corporate bond fund, which has a well-defined duration profile across the cycles. And about 15-20% can be used actively to maximize the returns across other debt categories. So even that duration side, I think, gets a lot more visibility as compared to very without the boundaries switching from one fund to the other. On the arbitrage fund side, the risk profile, I think, pertains to one, the operating policy rate. Last year, the operating RBI policy rate was 6.5%, so the returns of arbitrage funds were higher to that. And when we have seen 100 basis point of a rate cut by RBI, so the returns expectations of the arbitrage fund will get moderated. So the risk over there is what kind of interest rates in the market, and lower the interest rates, lower would be the carry over there. And then along with that, the equity market also has some bit of play over there, though it's completely hedged, but the spreads which the arbitrage fund is able to lock in depends upon the direction of the equity market. Thankfully, for last few years, we have been kind of in a bullish equity market trend, which means that there are more number of buyers in the market. And in this kind of a backdrop, arbitrage fund is able to get higher spreads, as in the higher carry, which helps the fund. If we were to enter into kind of a bit of a sideways or downturn on the equity market, it may lower the return profile of the arbitrage fund. Though in a very limited way, because over there the equity exposure is completely hedged, and the risk pertains to only that month-on-month spread that could be available. So yeah, broadly put, I think the risks are well known and acknowledged and appreciated by the investors in those existing classes. The new additional risk, or I could even say as an opportunity, which is there for this fund of fund, is to be able to actively switch around the debt funds, and even for that matter, the arbitrage fund. And if someone goes wrong in that allocation, then yeah, it is an additional risk. But I would say, the reward actually dominates the underlying risk significantly over here. And let's say if one was to believe that one can do a better job by actively switching the funds directly. So let's say someone puts the money in arbitrage fund now, and then after a couple of months, he may see opportunities on the debt side, like gilt fund or corporate bond fund, and he does it himself. So there would be a tax incidence every time that switch is made. So one will have to pay the tax whenever redemption is to be done from one fund and the investment has to be done on the other fund. And that can become very onerous for the investors. Now, in this fund, as in the fund manager, will do that job. And whenever the fund switches from fund A to fund B, there is no tax incidence in the hands of the fund or even the investor. So that way, it becomes much more efficient way of kind of switching into the funds depending upon the market opportunities, without kind of getting impacted on the tax incidence.
Right. Okay. Thank you so much. Next question. How long should the investor stay invested in the fund, right, to enjoy maximum tax benefits?
Well, for the tax benefit, I think one has to be clear enough to stay put for 2 years and not anything lesser than 2 years. Otherwise, the tax benefit will not be there. And if yeah, one was to have a horizon for less than 2 years, so maybe the underlying funds invested directly would do a better job. So a couple of months of investment possibly could be better handled by the arbitrage fund. And if one was to look at like close to a year kind of investment horizon or so, then the debt funds directly would do possibly a better job. But yeah, if one is looking for that 2 year plus investment horizon, then this fund will give better returns. And let me very quickly share my screen because I have a very wonderful slide which will help us in understanding the benefit of this scheme. Neha, just let me know if you are able to see the slide.
Yeah, I can see. Yeah, I can see
Yeah.
us.
So maybe I'll take a couple of minutes to explain it. So we have analyzed the data for last 10 years, and then we have seen the 2 year rolling returns of three categories. One is the arbitrage index fund, the second is the corporate bond index fund, and the third is this new FoF structure, which comprises of 60% of corporate bond index fund and 35% of arbitrage index fund. And we have taken the horizon for 2 years, is in the rolling peer returns for 2 years, because we believe that someone coming into this fund should come at least for 2 years, if not more. Now, very interestingly, if you were to see on the left hand side, which are the pre-tax returns of these three categories. So on an average, the arbitrage index fund. So these are the index benchmarks for the clarity of the industry reflection, and not the underlying funds. But if you were to look at the index benchmark returns of the arbitrage fund, on an average, the returns would have been 5.66%, which I believe would be very closely aligned to whatever would have been the RBI policy rate at any point in time. If you were to look at the corporate bond index fund, the returns on an average would have been like 7.44%, almost 1.8% higher than that of the arbitrage index fund. And then if you were to look at this underlying fund of fund structure, the returns would have been somewhere in between, but yeah, more aligned towards the corporate bond index fund. So these are the returns which are on a pre-tax basis, wherein corporate bond index fund second highest would be the underlying fund of fund structure, and the third would be the arbitrage fund. But when you look at on the right hand side, that becomes more interesting. So because there are different tax treatments for these categories. So arbitrage fund enjoys the tax benefit. If invested for 2 years, the taxation would be 12.5%. So the returns come down, but come down to a lesser extent. So it would be still close to 5%. When we look at the corporate bond index fund, which was giving the highest return on a pre-tax basis, because it enjoys the higher carry and the duration play, but it does not really enjoy the tax benefit. So post-tax, the returns are close to 5%, like 5.2%, which is similar to the arbitrage fund in a way. But when you look at this underlying structure, which enjoys the benefit of higher carry and duration through that corporate bond fund index in a way, and also the tax benefit because of this structure, where if one was to stay put for 2 years, the taxation would be similar to what one as of now gets on arbitrage fund. So that way, possibly it combines the best features of both the categories, and that's how you see the returns close to 5.9% are highest on a post-tax basis. So I think um, investors should look at this particular category more as an asset allocation for a longer term perspective. Minimum horizon should be 2 years, so as to be able to avail the tax benefit. But then, since it should be a part of a core allocation, I would believe that it continues forever. So it's not like one has to redeem this particular category, and then there could be better opportunities on the debt side in some other form or this structure. This particular fund will be able to capture, if the fund is being very actively managed, so it will capture the opportunities across the cycles, and it will continue to provide the tax benefit as we just highlighted over here.
Okay. Okay, could you walk us through the key fund details like expense ratio, SIP options, and exit load?
Yeah, sure. So this is a fund of fund structure, which means that the underlying funds are the key ones to be highlighted over here. So, in the interest of investors, we have decided to keep the expense ratio as low as possible for this fund of fund. So the direct plan will have an expense ratio of 4 basis point, and the direct plan will have the expense ratio of 44 basis point. So it makes a more cost efficient structure also for the investors to enjoy the benefit of asset allocation while also having the tax advantage through this structure. There is no exit load. One can redeem at any point in time. But yes, I would want the investors to come with a minimum 2 years of an investment horizon, because that's the nature of this fund, to provide that benefit of taxation. SIP options are available just like it is in any other fund, and the investors should be able to use this fund very actively for realigning the portfolio allocation depending upon the requirements.
Okay. Okay, thank you so much. Those are all the questions I had. Would you like to add anything else?
Well, yes, I think we've covered all the things. I can just say that I'm pretty excited about this category. It does give a chance to the investors to realign their portfolio profile with the debt also being a critical part of the overall allocation. And through this structure, it can be done in a much more tax efficient way. I think one thing should be just remembered that on the equity side, 1 year investment horizon gets a 12.5% taxation. And in this true debt category, the horizon should be 2 years, but the taxation is the same at 12.5%. So I think it helps in terms of achieving a prudent portfolio allocation for the investors. Underlying risks are quite well known and have been noticed for last many years. So identify the fund managers who have been able to manage the underlying funds in a more efficient way. The performance track record will reflect that clearly, and then accordingly, the investors can make the choice.
Okay. So that was a very, very clear and informative session, Vikas. Thank you so, so much for taking the time out and doing this with us. You've helped our audience understand how this fund, brings together the stability of debt with the agility of arbitrage in a way that's, both tax efficient and practical for today's investors. So, to everybody that joined us, thank you so, so much. We hope you found the session insightful, and we look forward to seeing you at our next FIOS webinar. Until then, happy investing.
Thanks, Neha, for having me here, and thanks to all the audience also.
Thank you.
Bye bye.